All right, boys, what's going on? I'm going to be doing a pretty in-depth video on the indicator, going through all the settings. I know we've done a couple videos like this before, but this is going to be the most in-depth, like the holy grail of the iFVG Ultimate Indicator. I'm going to break down all the settings, what they do. I'm going to try to move as quick as possible. I don't want to make this like an hour-long video, but I want to be pretty in detail too. I want you guys to have a good understanding of what each one of these settings does in the indicator. So without further ado, we're going to start off with detection. So detection, we have two options, series and single. Now, what this means is when we have a leg of price. So for example, let's go into replay mode and go back to here, right? This is actually a very good example right here. So we have this leg of price, right? I'm going to take off other indicators too, to just not confuse you guys. But here we go, right? We have this run up. And if you see in this leg, right, we're looking for obviously an inverse fair value gap entry, right? That's the whole basis of the indicator, right? When the indicator is on series, this is what it's going to do. It's going to look at, obviously we have a fair value gap here, right? We're going to turn it off for a second too. And then we have a fair value gap here and then here. So basically, this is the whole idea behind series and single. When the indicator is on single, it's only going to be looking for this fair value gap right here to inverse. So basically, we've swept liquidity to the left, right? We took out this high. Now it's looking for the closest fair value gap to inverse when it's on single. So if you see, I'll turn it on for a second. It's going to take a second to load, but we actually have a gap right here too. You see how there's a baby gap in here? So the indicator on single is going to alert as soon as we close below this singular gap. But obviously, if you want to be safer, the problem with this, right, is that in theory, it all depends on liquidity, but in theory, right, this gap might support price, this gap might support price. So there's two options you could play. You can either take an aggressive entry on this inversion up here, but the risk you run with that is us coming down and bouncing off this 1 minute gap and then continuing higher, right? So that is why it is risky to run single. Personally, I like to run single because at the end of the day, like, it's going to be based on the liquidity below. That's going to determine whether this is a good setup or not. But the safest bet is to run series because basically when it's on series, it's going to wait for every gap in the leg to inverse. So it's going to wait for every gap in the leg to inverse. So instead of alerting up here, let's play it forward. I think I have it on single, right? Do I? Single sensitive. We're going to go single sensitive. It should alert. You can even see it like a little bit in here, how it's highlighting the gap that it's looking at. So there's like this baby 1 minute gap in here. Once the indicator catches up, you're going to see it will get an alert on either this candle or this candle right here. Yeah, and there we go. We get the alert on this candle right here. But do you see how there's still a fair value gap right here, this 1 minute gap? So if you're not super familiar with like draw on liquidity, you're not super confident in kind of reading where the market is going to go or likely to go, I highly recommend in the beginning keeping it on series because let's see what happens here, right? All right, so we kind of hold this 1 minute gap. I mean, we did inverse this 1 minute gap, to be honest, but you kind of get the idea, right? So we do actually get the inverse of the entire leg, but once again, this is because of liquidity, right? We have previous week high resting right up here, right? So this is obviously the draw. I don't remember, we didn't even take previous week high, which is crazy, but this was obviously pulling price a little higher before we actually went lower to run all this low resistance liquidity down here. So this was kind of an interesting example, but basically, long story short, what I'm trying to get at, right? Single is going to give you the aggressive entry on the gap when this initial gap closes. So here it alerted here. Series is going to give you the alert all the way down here when the entire leg inverses. And as you can see right here, I'm going to turn it on series just for example's sake, but you should see it will alert right around here. Yeah, and there we go. On series, you can see it waits for this entire leg to get closed below right here. Now, also, I guess kind of shameless plug too, why did we not actually take previous week high? We drew back up to it, right? As you can see here, the short actually did fail. Now, in real time, you're watching this, right? This morning, personally, I actually was expecting previous week high to get hit. So for the sake of the indicator, like if you're watching the indicator, right? I did not take this short right here. I did not and would not take this short right here, especially with previous week high resting right here. I actually did take this long right here, and I simply got out at like a 1-to-1. I typically do not ever hold for the full draw. I'm not gonna lie. I really just do like to get my piece of the pie. I literally took just a 1-to-1 off this indicator alert right here. And that's how I've actually had like the most success in my trading so far. I'll actually pull up my P&L calendar to just kind of like have some credibility as to how I use this. This has been my month so far. As you can see, literally only one losing day. This is across 4 XFAs, and I'm not pulling this up like for any kind of like flex or anything. It's literally to show you like this month in particular, once I got into these accounts, like my main focus was just taking base hits, just going for 1-to-1 trades. And that's literally just what I've done. And it's been very successful for me and it's helped me out a lot. So I'm including that in this video to tell you guys, like, if you kind of focus on just that and getting very consistent, you can compound results very quickly. So that's what I took this morning with the indicator, just this simple long, thinking it was going to previous week high, but I didn't hold for the full draw. I don't like to target external liquidity. I literally just take a simple 1-to-1, right? And then if you were watching the indicator this morning, I would not take the short because of previous week high. And then a lot of people were asking, why did we not actually hit previous week high? And this is kind of, I guess, some sauce I'll throw into this video too. A big reason why was this was actually a rejection block on the higher time frame for previous week high. Now, I was still expecting it to get hit, don't get me wrong, but I did acknowledge that if you guys don't know, this wick right here, which was previous week high, this 1 hour wick, you can see that we swept a high to the left and we pushed up, we left a wick, and then we closed below this high. So this is actually a textbook example of what a rejection block looks like. And I actually have this indicator up. This is completely free to use. It's Rejection Block Pro Plus. It's an indicator that we made. And I actually like to run this all the time with the indicator because then I'm aware of where the rejection blocks are. Now, rejection blocks, you don't take them as like everything, right? Like draw on liquidity and bias is always going to be more important, but it's good to know where they are, especially like a rejection block at a key level. Like I was expecting previous week high, but I also understood it might not get hit because of the rejection block. And I only really knew the rejection block was there because I had this indicator on, to be honest. So kind of a shameless plug, but if you guys want to use this, I literally gain nothing from you guys using this. It really only helps. These are the settings that I run for it to just kind of keep it super clean. Like I usually remove box fill and then I just keep the gradient levels on. I'll change 50% to like red. And as you can see, it shows the higher time frame rejection block on the lower time frame chart. So yeah, that's that. This is a lot of yap. I just realized I am trying to kind of go through the indicator settings, but what's next? We have sensitivity. So basically sensitivity is going to determine the size of the gap. So basically I'm going to turn this off for a second. If you remember the beginning of the video, I had to change the sensitivity for this gap. This is a small gap. I would say like when the indicator's on sensitive, it's going to pick up these small gap inversions. When it's on normal, it's going to pick up inversions kind of more like this, where it's a slightly larger gap. And then when it's on, what is the last setting? Strict. When it's on strict, it's going to look for more of these type of gaps, like very, very large, obvious gaps. So that's kind of personal preference, how you want to use that setting. Personally, I like to keep it on sensitive. I like to see every inversion that comes from the indicator. But if you are more of a beginner and you're trying to train your eye to see those super obvious setups on the chart, I would go with normal, to be honest. And then strict, to be honest, I wouldn't use it too much. Stick with normal, especially if you're like beginner intermediate, I would go with that. Bias is pretty self-explanatory. It's either, neutral, bullish, or bearish. When it's on bullish, it's only going to show you longs. When it's on bearish, take a guess, it's only going to show you shorts, right? Hide losing setups. So basically this is a way to just keep the chart very clean. This is not us trying to be sneaky and trying to be like, oh, the indicator's so good. It literally just keeps the chart clean. So basically whenever a setup hits stop loss, for example, do we even have an example here? I don't know. I'll turn it off for a second. Yeah, here we go. Here's with losing setups on. So obviously you can see right here, like we had this grayed out signal right here. This was obviously a losing signal. This was a terrible signal. Like this is not one you should be taking. Obviously this just like looks like garbage basically. but you could see as soon as the stop loss gets hit, so the stop loss on this was probably like right here. As soon as it gets hit, it kind of grays out the signal and then removes it from the chart when hide losing setups is on, right? So that's basically how that works. Here was another one over here. This was also just buns. It was pre-market. But yeah, that's how that works. Allow 7 to 15 candle iFVGs. So I like to keep this on. I recommend most people keep it on. Turning it off will only alert you very V-shaped iFVGs. So basically, here's a good example, even just right here. This was an alert right here. This was an alert right here. And as you could see, it kind of took a while. Like this wasn't a very textbook like V shape. As you could see, like there were multiple candles in between. This is a very tiny gap in here and it took a while to inverse it. So this is actually an example of a setup that would get filtered out when you have this setting off. So this setting off will basically just give you these very V-shaped type moves like this, like going up here, going down here. These are very like V-shaped type moves. When the 7 to 15 candle setting is turned off, the best example I could find on my chart right now is just this one. Like it's not going to alert some stuff like this. So honestly, as a beginner, if you're trying to focus on just consistency and taking the best, highest quality setups and stuff, to be honest, maybe turn this off and try to experiment with that. That would be probably my best advice because it will just give you the very V-shaped type of moves that will run straight to your take profit. Like, and that's ultimately kind of what you want, especially as a beginner. So this is kind of like hit or miss. Like you can have it on, you could have it off. I recommend on. I use it on, but you kind of have to back test this for yourself. I apologize, I don't have like a really good answer, but require influx of volume. So basically what this is it's pretty simple. It literally just works off a moving average. So it's just looking at like the average volume of the candles. And if we have a large displacement candle, like right here, right? I think we would all agree like this is a pretty large candle compared to the most recent candles, right? So basically this is good because this is displacement. Like it's showing that price has energy. It's showing that price is willing to move higher with some, with some force behind it, right? So require influx of volume will only show those setups. I don't recommend having it on, to be honest, because sometimes especially after New York Open, when all of the candles are very kind of like large displacement candles, like right after open, sometimes it's not perfect, this setting, where sometimes it will actually filter out some setups that you would actually want to see. So I like to keep it off, and honestly, just keep it off, to be honest, because you can still see. So if you guys don't know, this dot next to the indicator, this is what's telling you that there is volume, right? If you want to trade the setups that have volume, just keep it on, but only trade the setups with the dot, basically. And you should be able to see all the setups. So I recommend keeping it off and just looking for when we have dots next to the setups. That would be my best advice for this setting. Required delivery from high time frame fair value gap. This one's actually pretty interesting. A lot of people kind of ask how this works. I will let me do a drawing to kind of demonstrate how this works. But say we have a high time frame fair value gap, and basically this is how it works, right? So when we have this gap, it's going to tell you, so basically say we have this high time frame fair value gap, right? This is how it works. So if it's an unmitigated gap, so meaning price has never gone into this gap before, like it's a completely new, just opened up gap, basically two things. The indicator is going to have like a little dot next to the label. So it will say like 15, it'll be like M15 and then dot. And that's telling you that this gap has never been tapped into before. So basically how the indicator works is as soon as we come up into it for the first time, and then we make a V shape and we get a signal, that is delivery from a high time frame gap, because obviously we've tapped into it and we're delivering out of it, right? So having this setting on, required delivery, is going to show these examples. So it's going to filter out a lot of trades, to be honest. The other thing with how this setting works is once we put in that high inside the fair value gap, the other way we can get delivery from a gap is if we come up and we sweep the highest point inside this gap and then make a V shape again. So this is basically, Dodgy talks about this a lot, if there's a high inside a fair value gap and we get a good reaction off of it, then, you know, say we V-shape again, we make a setup, this would be delivery from a high time frame gap. So the problem with this is it's not going to catch setups where we sweep session liquidity. So say we have like London lows down here and we get a very just textbook, like come down, come back up and make an alert here. Like this is a pretty textbook scenario where we sweep some kind of session liquidity and deliver. But if we don't have a gap down here, it's not going to, when you have this setting on, it's not going to show these type of setups where we sweep session liquidity, assuming there's no gap. It's not going to show this, right? So that's why I actually trade with this off, but you will get, I will say you will probably get higher probability setups with it on, but you will miss some high probability setups, like if we sweep equal lows and then deliver, or if we sweep equal, you know, session liquidity and deliver, right? You're missing those setups, but I do think this is somewhat higher probability with this on. Include current time frame delivery. I would kind of ignore that. I would keep it off, to be honest. This is the same idea, exactly like what I just explained with the fair value gaps, except it's using 1 minute gaps. So instead of this being like a 15-minute gap like this, it will just be a 1 minute gap. And basically that's good for like continuation setups kind of, but it's going to alert a lot more garbage when that setting is on, if I'm being 100% honest. So include current time frame delivery, I would keep it off unless you're like a really continuation based trader. Like this is a very like niche setting for certain people, so I would keep it off. Require session delivery is interesting because it's kind of the opposite of what I was saying before with the high time frame gaps, where the high time frame gaps, if you have that on the require delivery, it's not going to show sweeps of session liquidity. If you have require session liquidity delivery on, it's not going to show setups where we tap into like an unfilled 15-minute and then make a V-shape, or if we like sweep a low inside a gap and make a V-shape. It's not going to show these setups unless this is session liquidity, unless this is like London low or something, right? So honestly, I keep it off. I like to see all the setups. I like to see continuation setups. Like this setup from this morning that I took did not deliver off session liquidity. It just kind of delivered off, you know, basically like discount of the range, and we had a clear draw above. So you would not get this alert if you had require session liquidity on. One thing that you can do, which I've actually never experimented with before, if somebody wants to go and back test it and be my guest, require delivery from gap and require session liquidity delivery, you will probably get 0 setups doing this, like probably like 1 setup a week, maybe like 1 setup every 2 weeks, 3 weeks. But I guarantee you those are probably the most high probability is if you have both of these on. But like I said, I don't think you're going to get very many setups doing that, but technically should be the highest probability. Require break even not breached on inversion. So this is a little complicated, a little confusing, but basically say we have this, right? Like say we have a gap in here to be inverted, and then we have a high right here, and this is our break even, and then say we have like some kind of high up here, and this is our TP1. So this is break even, and then this is TP1. I kind of apologize. These drawings are kind of trash. I hope you guys get the idea. But so basically, require break even not breached. This is what it means, right? If we inverse this gap right here and we get an alert, the break even point has not been breached yet. We haven't reached it yet, right? So it will just fire this alert. Now, say we did something like this. Say we have this gap right here, and then this candle comes up and it closes up here. So clearly we got an inverse fair value gap in this leg, right? We got a whole inverse in this leg. However, this was the break even spot, and the candle that closed above this inversion right here, it closed above the break even. basically it's not going to alert these setups when you have this on. So technically, this is the safest option, is to have this, because obviously if your trade has hit your break-even spot, right, the spot where it could reverse from, you don't want to be entering the trade at your break-even spot, right? So this indicator setting is like a safety mechanism that prevents signals where this happens, where it's telling you to enter at your break-even spot. That's obviously a bad thing, right? The only downside with that is if we have a super clear draw on liquidity, like say we're kind of like trending up, right? And we're heading towards like London high or something. And then say we did something like this, and then we like closed up here or something, and this would be the break even, but we know it's going to, like, say London's like right here or something, right? Like clearly here, like obviously this is all depending on context, but like I would still take something like this if I knew where the draw was, even though we closed above the break even spot, because I don't know, it all kind of just depends on liquidity. But for you guys, I would say require break even, not breached. I would just keep it on, to be honest. I'm kind of like, I feel like I'm yapping. I'm not explaining it too well, but keep it on. This is the safest option for sure. It will prevent you from basically top ticking in the wrong direction. I know so many people have probably done that. I've been there where like I enter a trade and it reverses straight from where I enter. This will kind of save you from that in the beginning. So require macro time, definitely keep it off, but you should be aware of when the macros are. So 9:45 to 9:15, or technically 9:50 to like 10:10. I think I misspoke. I said 9:45 to 10:15, yeah. And then 9:50 to 10:10. That's technically like the original macro time as ICT explained it. Technically, this is going to be the highest probability time for your setups to deliver. So I would be aware of when it is. So like I said, the last like 10 minutes of the hour, that's the most likely time. Like the highest probability setups are going to form in that window, but it's not 100% of the time. Like I wouldn't take it as like gospel. Like I wouldn't, put your everything on that. Just be aware of when the macros are and keep this setting off. That's my best advice to you guys. Obviously, having it on will only alert trades in this time window, whatever you select, whether it's the first 15 and last 15 or the first 10 and last 10. And then finally, we're gonna wrap it up. Minimum DD grade to display. This basically goes based off the checklist, right? Now, the problem with the checklist, I'm gonna pull it up really quick. The problem with the checklist is it is super mechanical. And the problem with that is the way you wanna be using this indicator, and I've said it in multiple videos now, and I've said it a couple times here, is it really is depending on where the liquidity is. Like you really wanna know where the draw on liquidity is. That's what's gonna make this indicator like absolutely amazing for you guys. It's just, if you can identify where you think price is likely to go to, for example, we have like relative equal lows here. This is a draw on liquidity. We have low resistance liquidity here. This is a draw on liquidity, right? This is what makes setups like very good. It's really not like so mechanical where it's like, oh, we have a liquidity sweep, we have delivery, we have volume. It's not as simple as that. Like it really is just like, where is the market more likely to go and how do we get in on an entry to go to that destination, right? Like the market already knows the destination. It's just how can you catch an entry to it? So having a checklist like this is great, but it's so mechanical because it doesn't account for like just bias and market direction, right? So that's why, for that reason, I tell people to always keep this on C. It's gonna show you the best setups, and ultimately you don't wanna be a signal bot. You don't wanna like think like, oh, like I'm only seeing A+ setups, so I should always get the best of the best setups. Like the best of the best setups are gonna be when you know exactly where the market is more likely to go to. That's gonna be the best of the best setup. So it doesn't matter what's going on in this checklist. If we have an alert and you know where the draw is, that's a good setup right there. And that's all there is to it. So even though the indicator will say like, oh, this is an A+ setup, is it really? I don't know. Obviously these extra confluences like SMT and volume help, but it's not everything. It's not how the market moves, obviously. It's not gonna move based on what's going on in this checklist. So for that reason, I tell people keep it on C and develop a really good eye for knowing where the market's going. And that takes time, that takes back testing and experience, but that's part of the game, right? Like this tool, I think with the indicator, it does help your learning curve a lot. Like it helps you see the setups very quickly, like much quicker than if you didn't have the indicator. But it's not going to completely just eliminate, you know, like needing to learn how to trade too. You still have to kind of like know what you're doing a little bit. And this is just basically a shortcut, but it can't shortcut you all the way. You still have to put in the work, right? And then number of setups displayed, this is obvious. This is just how many setups are on your screen. And then if you guys don't know, I mentioned this in the last video, but every setting up here is going to affect how the indicator works. So everything we just went through now, this affects the type of setups that you see on the chart. These right here are the settings that I run on a daily basis. This is it exactly as it is. You guys can experiment with it. I encourage you to go back test with it and figure out what works best for you. But me personally, this is what works best for me. And if you are a beginner, these are probably still the best settings for you. I would put it on series, maybe go to normal if you're a beginner, and then maybe turn off allow 7 to 15 candles. But that's it. Like I wouldn't touch anything else, to be honest. Like there's no magic setting in this that's gonna make you 100% profitable. Backtest, figure out what works for you, copy these for now, experiment with these different ones, like, but that's all you could really do, right? And then, so I kind of was mentioning this, everything up here affects how the indicator works, everything down here affects how the indicator looks. So anything down here, you can mess around with any of this, it's not going to mess up anything really. Except for this, I'm glad I actually caught this. This is the one thing, is stop placement. So you can actually you can choose where you want the stop placement on the indicator. A lot of people ask, like, would you do wick, body, or inversion? Personally, I would keep it on wick if you're a beginner, and just kind of roll with that. I like to use a mix, and it all depends on the market conditions. Like, so right now in these current markets, you can see a lot of people on social media are winning. Like a lot of people are having a very easy time trading inversions right now. And in these market conditions where we're very clearly just delivering to the draw on liquidity and we're moving very nicely, I actually like to put my stops at the body of, where is it? I can't find it. I like to put my stops at the body, because typically we're not having this like rangy and wicky type price action where it will like take you out or like form an SMT at the high and then go. Like body has been working for me, but there are certain market conditions where there's a lot of consolidation on the daily time frame or the 4-hour time frame. When you see that kind of consolidation type price action on the very higher time frames, either don't trade or be more careful with your stop placement and put it at the wick. That is my best advice from experience. That's what I've seen. I've been trading the market for over 2 years now, and that has been like what I've seen from personal experience and back testing. So once again, personal preference, wick is always going to be safest. In good market conditions, body is going to be the best. I never really do inversion. I personally don't. I've had the most success with body. But once again, you know, that's going to be up to you. I can't really tell you guys how to trade. I'm just trying to give my insights as much as possible. So I think that's really everything. I know this was kind of a yap sesh. I didn't want to make this video too long, but, you know, I've been kind of enjoying making content for you guys, and I'm starting to, you know, get comfortable doing it, I guess. So I'm going to continue to pump these out as much as possible. And if you guys have any video requests or anything at all, like even with my personal trading journey and maybe trying to help some of you guys out too, like, I'm here to answer questions in both my server and Dodgy's indicator chat. So whatever you guys need from me, let me know. And yeah, I hope this was helpful.